Hello, Scott.
There we go. How we doing?
Doing good. How are you?
Doing all right. See if I can get everything set up here. It's
Sounds good.
always a little bit of a dance, trying to make sure that everything comes up how it's supposed to.
We know that dance well.
So much fun, isn't it? All right. Let's see if I'm allowed to share. Do-
We'll
Let's,
just give it a couple minutes for
yeah,
others to
sure.
join us, and then we'll do a little introduction and then jump right in.
All right.
Welcome, welcome, everybody. We're excited to have you here today. It is our last financial wellness workshop of 2024. Cannot even believe it. Today, we're talking about investing for your dreams, and you will all be receiving, if I guess I should say, if you earned your Healthy Lifestyles incentive, you'll be receiving that tomorrow on your paycheck. So perhaps maybe that incentive could be the first thing that you use to invest for your dreams. We have Scott Sherman here today from Mountain America Credit Union to go over all of the ways that we can make those dreams come true through our finances. So, Scott believes anyone can create a stress free financial life with the right education, tools, and guidance. He shared that message with tens of thousands of people as a personal finance writer, speaker, and coach for 5 years before becoming a financial education manager. He loves to help people find the resources that will make their financial dreams a reality. Scott is a Michigan native who has spent the last 16 years in Utah. He enjoys spending time with his wife and daughter, and on the weekends, he plays the drums in a rock cover band, Dangerously Close. You're a well-rounded fella, Scott.
Something like that, right? Sounds good in a paragraph.
Oh, yes. We're happy to have you here today. I'll turn the time over to you. And if you have any questions, please throw them in the chat and I'll relay them to Scott.
Sounds good. And I'll have the chat up here. So I always preface this with saying if you see me looking all over the place, I have the chat up on a screen here. I have my presentation over here. I've got my slides down here. So I promise I don't have squirrels all over the place that I'm looking at. I'm just trying to keep track of everything. So yeah, with this one, definitely love some participation. And feel free if you have questions along the way, you can throw them in the chat. Usually we have some time for Q&A at the end if there's questions you want to wait until the end. And I'm going to ask for some participation using the little emoji things and the hands and the chat and all that stuff. So hopefully we can get into that today. We're going to talk about my favorite topic to present on, which is investing. I really love talking about investing because I feel like it's something that is scary for a lot of people. It's something that they're not sure they know how to do, or they're afraid if they do it wrong that it's gonna be the worst thing they could do. And I want to show you how important it is for you to invest and how easy it can be for you to invest. and really make a huge difference in your life. So with that said, let's talk about what we're going to hit today. We are going to help you understand the effect of time on your savings, look at some common investment options, talk about the different types of investment accounts, and then talk a little bit about the difference between risk and volatility, which people often confuse, and they are different. So we want to make sure you understand that. So the first thing we're going to do is we are going to talk about the effect of time on your savings so that you can see that even small contributions can make a big difference over time. So we're going to start off with a story about a penny. And this is not just any penny, it's a very special penny. This penny is going to double every day for the next 30 days. So on day 1, it's going to be worth 1 cent. On day 2, it will be worth 2 cents. The day after that, it will be worth 4 cents, so on and so forth. So what I'd like to do is have everybody use your little hand icon, which I think you can probably find at least at the bottom of my screen. It's there. You can raise your hand, right? Everybody go ahead and hit the raise your hand button so that we can do a little game here. Let's see if I can see. Of course, maybe as the non-host, I can't see your hands raised. Sadie, can you see hands raised on your end?
Yes.
Okay, so you're gonna have to be my eyes and ears here. I want you to watch. Okay, everybody's hand is raised. Now I want you to keep the hand raised because we're gonna do a quick survey on what you think this penny is gonna be worth after 30 days where it's doubling every day, okay? So put your hand down when we get to the number that you think, okay, it's not gonna go higher than that, all right? And Sadie, let me know when we get to the point where everybody's hands are down. So if you think that this penny is gonna be worth more than $100 in 30 days, go ahead and keep that hand raised up there. If you think it's gonna be worth less than $100, click the button and take your hand off. All right, if you think it's going to be worth more than $500, go ahead and keep your hand up. If you think it'll cap out before that, take your hand down. How about more than 1,000? More than 10,000. So if you think it'll still be worth more than 10,000 after 30 days, keep your hands up. How about more than 50,000? More than 100,000? Sadie, we still got people with hands up here at 100,000?
We do have a couple hands up.
All right. How about more than 500,000? More than 1 million? We got any takers at more than 2 million? Still got some hands up here?
Still got some hands up.
All right. How about more than 5 million? And let's stop there. Okay, how many hands we got left up? More than
we have 4 hands up.
4 hands up. All right. Well, let's see where this penny ends up. We've got some mighty optimistic people. All right. So remember, day 1 it's worth 1 cent, and it doubles every day. So it's going to be worth 2 cents on day 2, 3 cents or 4 cents on day 3. The end of day 7, we have 64 cents. Right. Whopping 64 cents. Not bad for a penny, but that's not probably going to change anybody's life. At the end of 2 weeks, our magic penny is worth $81.92. At the end of 3 weeks, our penny is now worth almost $10,500. Okay, so 3 weeks in, we still have a little bit more than a week to go. We're at $10,485. On day 25, we hit 167,000. Day 26, we're at 335,000. Day 27, 671. Day 28, 1.3 million. Day 29, 2.6 million. And day 30, $5.3 million. So the people who had their hands still up, you won. Congratulations. I wish I could give you this penny. Unfortunately, I can't, right? Because that penny is not real. But the concept behind that penny is, so the penny does something called compounding. And over time, compounding allows the value of small amounts to increase over time to the point where the things that you originally invested are now earning money on their own. And so your money is making money. And that is a really impressive thing. And compounding is so cool that the rumor is this guy here that you might recognize, Albert Einstein, once called it the eighth wonder of the world. Now, the authenticity of that particular quote coming out of Einstein's mouth is a little dubious, but I can tell you that the concept of compounding is not. It is a legit thing. It is the reason why time can have a big effect on how your savings goes. And that's the reason why that magic penny can be worth so much in just 30 days is because over time, compounding has a big effect. You remember it wasn't worth as much earlier on, right? So you might not be that impressed by how much it was worth in 20 days, right? Or 10 days or 5 days. But when it gets to that 30-day mark, the time has allowed it to really compound and be super valuable. And so our penny example is a lot like what we want to see out of our overall investments. So we're going to talk about a few people right now. We've got some people here on the screen. They are each just starting their investing journey. And each of them wants to be a millionaire by the time they turn 65. Now, they're all starting out with 0 in their retirement account, and you can see their ages underneath their names, right? So we have Elise, who's 18, Aaron is 25, Beth is 32, Hector 39, Sandra 46, and Lee is 53. And so we want to see how each of these people is going to have to save based on their age in order to be a millionaire. And to make it easy, we're going to assume that they're investing in the same thing. Okay, so each of them wants to be a millionaire at age 65. They're starting at different points in life, but their average return, they're going to invest in something that returns 10% per year, which is the S&P 500 long-term average is right about there. Okay, so that's what they're all going to invest in. And I want you to put in the chat, how much do you think our 18-year-old Elise is going to have to save per month from age 18 to age 65 in order to be a millionaire? Let's start with her and see what people think. Go ahead and stick it in the chat there. How much per month does she have to save at 10% per year return to be a millionaire at 65? All right, we've got one person says $100 a month. One person says I don't know, that's $2 a month or $200 a month. Right now it looks like $2 a month. 50, 500. Okay, so we got a pretty good range of answers here. It feels like The Price is Right, where you're like $1. All right, and then next question: how much do you think the 32-year-old is going to have to save per month in order to be a millionaire? So we've got answers ranging from $2 to $500 a month for the 18-year-old. How much for the 32-year-old? Got 400, 150, 75, right? So we got answers all over the place again. 800. All right. Well, let's see what these people have to do in order to get there. So we're going to start off, of course, with the youngest person, Elise. So she has to save $79 a month. If she saves $79 a month from age 18 to age 65, she's going to save of her own money just $45,000, a little over $45,000. And at the end of that time, she will have $1 million in her account. Right. So we had some people who were pretty darn close on the chat. We had, let's see, Daniel was at $100, Anna was at 50. So kind of split the difference there between those two. Then we have Aaron, he's 25, right? He's got to save about double that, right? So $156 per month. And in total, he's going to save 76,000 and change of his own money in order to be a millionaire. Now, Beth, our 32-year-old, we asked about her. She's going to save $309 a month. She's going to save a total of $126,000 from age 32 to age 65, and her balance is going to be $1 million. Hector, he's 39. He's going to save $626 a month. Now, this is where things start to get interesting, right? Because a lot of people don't get serious about looking at this stuff until they're in their early to mid 30s, right? And so when we start to get up in these ages where people start to think more about retirement, oftentimes they feel like I'm so far behind, or I don't know if I can catch up. I don't know if I can use that much, save that much. And if you look at it, $309 to $626 for a lot of people, that's a car payment, right? That is something that you might already be paying, that in theory, right, if you have a car payment, you get that sucker paid off. Now that money becomes available for other uses. That could be the kind of thing that could help jumpstart somebody who's in their 30s to say, this is where I find extra retirement money if I haven't started yet. Now, remember, these people start with zero, right? They're all starting from zero. So if you've already started, you've got a little bit invested and you're this age, you don't have to save that much, right? You could save less and still get to the same place. Now, Sandra, our 46-year-old, she's got to start saving more, right? We're starting to get up into mortgage payment type territory. $1,323 a month, and she's going to save $300,000 of her own money. And then Lee, our 53-year-old, who gets started much, much later than the others, he's got to save $3,090 a month, and is going to have to save almost half, right? $482,000 of his own money to get to be a millionaire by age 65. So let's look at the extremes here. What do you notice? What's the biggest difference between how much Lee has to save in order to get to $1 million and what Elise has to save? What is the difference? What does Elise have here that Lee doesn't? Yeah, time, right? So because Elise starts earlier, she doesn't have to put nearly as much in, and she gets the value of all that compounding over the time, right? So the key takeaway here is, even if you're starting later, a little bit will go a long way versus waiting and waiting and waiting and saying, oh, I'll have to get to it next year. I'll get to it next year. I'll put it, I'll start to invest when I make more. If you can start now, today is the best day for you to take advantage of compounding. Even if you're not 18 anymore, you missed that train. If you're 32, 39, 46, wherever you're at today, you have the most amount of time on your side to allow compounding to do its thing. So don't be daunted by the number that you have to save. Be excited by the fact that today is the day that you actually have the best amount of time to allow your money to make money for you. And start there, and that's going to help make it so that you can get to where you need to be in the end, right? Where you want to be in the end. So let's ask this big question then. How much do you personally need to save? That is the big question that a lot of people ask, and it depends on a lot of things. There is no one size fits all answer. Maybe you don't need to be a millionaire, or you want to be a multimillionaire. Maybe you're looking at a very specific amount of money or an age that you want to be able to retire at, or certain things. It's going to be different for you than it's going to be for your coworkers, right? And so you don't need to know the right answer or the exact answer in order to start doing the right thing, which is to do your future self a favor and start investing now and do a little something to start moving you in that right direction. So there are many ways to approach, how much do I need to personally save? But you don't have to know that answer today in order to get started and sort of figure it out on the way. So let's dive into one kind of rule of thumb that can help you to understand, how much do I think I want? It's called the rule of 72. So the rule of 72 is a shortcut that you might find helpful trying to figure out, okay, how do I get to where I want to be? So we've been talking about compounding, and compounding is one trick that's going to help you get there. And you have to figure out, well, how quickly does my money, compound? How quickly does it work? If you think about that penny, we knew that penny had a 100% rate of return every day. And so we were able to figure out where does it end up after 30 days. Now, compounding is going to happen faster if you have that higher rate of return, and it's going to happen slower if you have a slower rate of return. But you can use the rule of 72 to figure out how long it will take for your money to double, right? So our penny doubled every day, but our regular investments aren't going to do that, right? So let's look at this. The way that you use the rule of 72 is the time to double equals the number 72 divided by your rate of return. So let's say you invested in that S&P 500 average long term. You got the average 10% return. That would mean that if you take 72 divide by 10, your money's going to double every 7.2 years. Okay, so if you put $1,000 in and leave it sit there in that 10% rate of return, after 7.2 years, now you're going to have $2,000. If you wait another 7.2 years, now you're going to have $4,000. Wait another 7.2 years, you're going to have $8,000, right? So that's a way that you can kind of see, okay, here's where how my money is going to grow over time. But let's say you don't feel comfortable investing in something that averages 10%. Maybe you're more risk averse. You want something that's maybe a little more stable or doesn't fluctuate as much, and you don't want to lose any money. So you say, I just want a guaranteed return. I just want to invest in something where I know what it's going to do over time, and I want to make sure that I don't, I'm not going to lose money. So you decide to invest in a certificate of deposit. That's guaranteed that, over time, you're going to get a certain rate of return. And let's just say we'll use today's, numbers. Let's say you get a 4% return every year. And let's just say you can lock in a certificate for the remainder, whatever. So in order to do that, you take 72, you divide by 4, right? The percent that you expect to get your return. And you'll see that it takes 18 years for your money to double, right? So at 4% return, you're going to have to wait 18 years before your $1,000 becomes $2,000. You're going to have to wait another 18 years before your $2,000 becomes $4,000. Now, that doesn't mean that you shouldn't invest in the 4%. What that means is, in order to get to the same place as somebody who's investing in a more aggressive way, you're just going to have to invest more up front, right? So you're going to have to invest more money so that when it doubles with a bigger amount. And so that's where you can personally start to look at, what is my risk tolerance? What is my goal here? How much time do I have? Now I know, okay, if I have this much time, here's how much I need to invest in the things that I'm comfortable investing in order to get to my ultimate goal, to where I want to be. So that's how you can use this very simple rule of 72 to kind of get a sense of, all right, how much do I need to save based on where I'm at, how much time I have left, and what my end goal is in terms of a dollar value. Now, this is a good time to recognize not every financial goal is an investment goal. Sometimes what you're really looking just to do is save, right? And so sometimes when we're saving, we want to make sure that we're not doing something too risky. So you'll have short-term goals, mid-term goals, and long-term goals. And we want to know that, short-term goals and a lot of mid-term goals tend to be savings goals. They want to be things that we put money aside and we make sure that we have that money available for us when the time comes to buy them, because they're short term, right? And short term can be like 1 year, 2 years, something like that. Midterm goals tend to be somewhere between 3 and 5 or 6 years, depending. And then our longer term goals usually will tend to be 8, 9, 10 years or more, right? So let's look at these examples here and stick in the chat which two of these are short-term goals that we would just want to save for. And you can just put the number in there if you want to. They're numbered 1 through 6. Right, vacation and car. Yeah, so numbers 2 and 4, those are short term, right? Those are things that we're going to want to make sure we have the money available for us when we go to buy the car or when we go on vacation, right? We don't want to put that at risk. We're not trying to outrun inflation or anything. We just want to make sure that we've got that money there. What about our midterm goals? Which two of these would be more like midterm goals, where we might be able to invest some of it, but we probably aren't looking to get super crazy in our investments and outrun inflation? Yeah, so 1 and 5, funding college for an 11-year-old. So typically, right, people will end up going to school after high school, which would be about 18. So you're looking at about 7-year time horizon for an 11-year-old. Now, if we're thinking about that, right, that doesn't necessarily just mean savings, because a 529 educational plan is an investment vehicle that's intended for people to save for college, right? And so you can actually get a little bit more juice for your squeeze if you're investing in a 529 college fund that is designed to get a little bit more early on, right? Be a little more aggressive when your student doesn't need that money, versus get a little bit more conservative, so that you have the cash to pay for the bills when they come due, in that 18 to 22 kind of typical range for somebody to go to school. And then, yeah, number 5, if you want to get a house in 5 years, you probably want to make sure that the money is there. The down payment is going to be there, right? You're not looking for, oh no, the market went down and now we can't get our house because we don't have what we thought we would have for our down payment, something like that, right? So those are midterm goals. Can you invest with those? Absolutely, you can. Do you want to invest as aggressively as probably a long-term goal? That's up to you, of course, but you wouldn't usually be recommended to do that. You would say maybe invest in that certificate of deposit, where there's a guaranteed return over a certain time horizon. You can get a little bit more money than just setting it in a traditional savings account, but it's not at risk like a market instrument might be. And then that leaves our last two, our long-term goals, which would be number 3 and number 6, right? So if you want to buy a vacation home in 15 years, you've got some time to save for that, right? That's not coming right up. And then retiring in 25 years, again, you've got time on your side. So you can allow compounding to do a lot more of the work. You can do more of the investment side of things, because you have time to allow market ups and downs to happen and to recover from those things and to make adjustments along the way. So just remember that, when we're talking about investments, you don't want to try to make everything an investment. Some things you just want to have a good savings for and a good savings plan. All right, so now that we understand the importance of time in doing all this stuff, let's look at some of the common investment vehicles that you can invest in. So there are a bunch of different ways to invest, right? Common ones that you'll hear about: stocks, bonds, funds, commodities, futures, crypto and currency trading, and real estate. There's others, but these are pretty common ones, right? And we're not going to be able to cover all of these in this talk. So we're going to talk about the three that we've got up top there in bold. These are kind of the most common ways that people will invest. And we want to make sure that we cover these, first, because this is where a lot of people end up putting a lot of their investments traditionally. Now, before we get to that, I want to make an important point here. There is a difference between investing and gambling. And we don't want to talk about gambling, right? We're talking about investing. So investing is a long-term financial strategy for growing wealth. It's reasonably predictable, and it has a realistic expectation of returns. Gambling is typically a short-term action where you're hoping to make a quick return, and it's typically fairly unrealistic or unsustainable. Can you gamble in the stock market? Absolutely. You can gamble in the stock market trying to figure out what the next hot stock is so that you can get in today and get out tomorrow and make a quick buck. That's not what we're talking about. We're not talking about trying to read the tea leaves and make decisions based on that. What we're talking about is investing for the long haul, using reasonably predictable and historically justifiable numbers over a longer time horizon. So I just want to make sure we get that out of the way before we jump into talking about stocks. So when most people think about investing, the first thing that comes to mind is the stock market, right? So let's clarify what a stock is, right? When you buy a share of a company, a share of stock, you actually own a tiny little piece of that company, right? So if you want to buy a piece of Walmart, you think Walmart's a great company that's going to grow over time, you want to buy into that, you can buy a share of Walmart and you can own a little piece of Walmart. And if Walmart does well financially, there's a good chance that the value of your investment will go up. And if they don't do so well, there's a chance that the value of your investment will go down, right? The price is determined, though, by supply and demand, which is basically how much is somebody else willing to pay for your share if you own a share, or how much are you willing to pay somebody else for their share. So the actual value of your stock isn't determined until you go to sell. When you go to sell, then you will realize the gain or loss on that stock. This is where a lot of people start to get confused, right? If you own stock or you have shares in your 401k or an investment account, and you go and you look at your balance from day to day, and the market goes up and down all the time, right? That's what it's supposed to do. If you look and one day you've got a share that's worth $50, and you look the next day and it's only worth $30, you might freak out and say, "Oh my gosh, I just lost money." Right? I just lost $20 a share on this stock. But you didn't, right? Unless you sell. What you're looking at are the paper values of your current shares, right? Where they sit today. Once you actually go and sell, now you've determined what the value is, whether that's a loss or a gain. And so you want to be careful to not look at the day-to-day fluctuations and think that that's the actual money that you have right now that you've gained or lost, right? Because it will change from day to day. And if you understand that and expect that, it'll help you to weather those storms where, yeah, it's gone down for a while, right? Or it goes down and you're waiting for it to come back. But if you don't need that money today, you haven't lost anything, right? If you can hold on, ride it out, it could come back. And then when you do sell it, hopefully for a gain, because that's what I hope everybody gets to sell their stock at, then you'll realize that gain and you'll see the actual value of what those shares are worth. Now, bonds are different than stocks in that when a company or a public entity wants to raise money, but they don't actually want to sell an ownership stake in that project or in that company, they can offer a bond. And so they'll say, hey, if you loan us some money today, we will pay it back in a certain amount of time, and we will pay you a certain amount of interest over that time because you loaned us this money. So the idea is, you know what the value of this bond is going to be. You know what it's going to pay over time. You know when you're going to get it back. Now, one of the things that people will often say is, well, bonds are less risky than stocks, right? Or bonds are guaranteed returns. And that's not actually true, right? Because much like stocks, not all bonds are equal. So when bonds are issued, they're issued by companies or government agencies. And the only way that those bonds are going to be returned is if those things still exist, right, at the time that the expectation is they're going to pay that out. And so sometimes companies that are really stable, or government agencies, right? If say your local school district wants to, build a school, they could offer a bond, and you think the school district is going to be around in 10 years, then there's a good likelihood that you're going to see that money if you invest in that bond, right? But there are also companies that are trying to raise money that are maybe not as financially stable. And they'll tend to offer bonds that will have a higher return, a higher rate of return, in order to entice people to invest in that company, even though financially it might be more of a risky proposal, right? And on the extreme end of this, they're called junk bonds. You may hear that term, right? And so if you go in and you invest in a junk bond and they say, hey, we're going to pay you 15% in 5 years for investing in our bond, you're saying that you hope that that company is going to be there to pay that out, but it might not be, right? And so don't think that a bond is necessarily less risky than investing in stocks. It's a different type of risk, right? And so it's a slightly different sort of risk calculation. But typically, if you're investing in a bond that is through a city, a state, a school district, a company that's got long-term value, they're going to offer lower returns, but they're also going to be there to pay them out, in the long run, typically. So that's one of the big differences that people often underappreciate, I guess we'll say, about bonds, is that there is risk involved in those as well. And then the last category of investments that we want to talk about are funds. There are a few different types of funds, but funds, generally speaking, are a collection of other investments that are packaged together and then they're sold as one thing, right? So when you buy one share of a fund, you're actually buying a little bit of a whole bunch of different things that make up the different components of that fund, right? And that's going to be different for each fund. And not all funds work the same either. Some are actively managed to where they're kind of always swapping things in and out, trying to, beat the market or trying to increase value. And then there's some that are passively managed, where they say, hey, here's all that we're going to invest in this fund, and that's it. Or this is how we're going to invest, and over time it might change, but this is exactly how it's going to change, right? It's not a guessing game. Typically, your more actively managed funds will have higher fees, and they're going to be doing more trading and things like that. Whereas your passively managed funds are going to have lower fees, and you'll see less movement in terms of what they're investing in on average. All right, so let's look at a few different types of funds. Common ones, mutual funds. So with a mutual fund, what you're doing is you're pooling money with other investors to mutually buy some assets. And these can, again, be passively or actively managed, but most mutual funds are actively managed. They have somebody whose job it is to move stuff in and out of that fund, right? Ideally to make more money for investors. That's their goal. They're often going to require a minimum investment threshold. Might be $3,000, $5,000, right? Something like that. And you're going to be able over time to also purchase fractional shares, right? Because you're mutually invested with other people. If 10 of you want to buy a tenth of a share, that adds up to one share. So the management company can buy one share, but each of you only owns 1/10 of it, right? So you can buy fractional shares. And one of the interesting things about mutual funds is they don't trade when you say you want to buy or sell. They only do it once per day. And so if you decide at 9 a.m. that you want to buy shares or sell shares of a mutual fund because you're looking at the price right then, it's not going to change, right? The price is set at the end, and everybody buys or sells at the end of the trading day. And so mutual funds work a little bit differently than, say, your stocks, where a company might announce something at noon, and the price will change a lot between 9 a.m. and 5 p.m. Right? And so you could get the difference there. You can't make that sort of pinpoint sale or purchase on a mutual fund like you can with some other things. For instance, exchange traded funds. So exchange traded funds work a lot like stocks, right? They're traded on the stock exchanges, but they are funds where there's a bunch of different things that are under that. And usually the minimum purchase price for that is just whatever the cost of one share is, right? So you can't buy your fractional shares in those the same way, but you're going to be able to trade those in real time, right? They're traded on the open market. So they're bundled like a mutual fund, but they trade like a stock. The next one is really common in your employer retirement accounts. They're called target date funds. You'll typically see these. They usually have like a year at the end of them, right? So it'll say target fund 2035 or target fund 2050. And what they're saying there is, this is the time, the year around which I want to be able to get to this money. And so their goal is to adjust the mix of what's in the fund over time so that it's a little riskier early on, right? It has more potential for growth early on. And then the closer you get to that target date, they're going to adjust the mix so that it's less volatile, so that you can look at that and say, yeah, I have, $300,000 in my retirement account, and I can reasonably expect that that's what I'm going to be able to retire with. And so for a lot of people, this is kind of the easy button, right? This might be even the default in a lot of employer plans to say, based on your age, if you were to retire, at 65, this is the target date fund that we're going to put you in. And so you'll see that be a fairly common option. But again, you don't have to manage anything inside of that. There's somebody who's shifting those assets as you approach the target date so that they're less volatile. And then the last thing that we want to talk about are index funds. So index funds are usually passively managed funds, right? So they typically will have lower fees than those active funds. And their goal is simply to try to match the results of an index as closely as possible. So that index might be the S&P 500, the Russell 1000, or even just the total stock market. So they're not intended to outperform the market. They're intended to match the market. So when we talk about this, a lot of people don't understand, well, what does that even mean, right? What is the S&P 500? What is this index? So I'll show you. Here is a screenshot of the S&P 500 at a point in time here. And you can see a bunch of stock ticker symbols. If you see some that you recognize, why don't you just go ahead and type those in the chat. Take a look at some of those names there and see which companies you recognize from their stock symbol. Amazon, yep. Apple, Google, Microsoft, Tesla, JP Morgan, Nvidia, Costco. Yeah, these are big companies, right? These are companies you know. In fact, they're the 500 largest companies in America. And that's where the S&P 500 comes from. So the S&P 500, Standard & Poor's, tracks these. And if you buy one share of an S&P 500 index fund, you're actually buying a little bit of all of these companies, right? So one share of an S&P 500 index fund is purchasing a little bit of the 500 largest companies in America. And so in that case, with an index fund, you don't need to know which company is going to do better than others. You don't need to watch, when earnings come out to see whether a stock is going to go up now or it's a good time to buy. You just straight out own all 500 of these companies in a proportion to the Standard & Poor 500 index. And so for a lot of people, again, this can be an easy way to say, I don't know what to invest in. So I can invest in a lot of things, right? Without having to go through and actually choose those 500 companies. I just choose one index fund, or, in this case could be Standard & Poor 500. You could do total stock market index so that you own a little bit of everything that is on the index and just have it all. So that's how index funds work. Now let's talk about one of the aspects that people often get nervous about, which is risk and volatility, right? This is typically when people start to get worried about investing. They say, I don't want to lose money. I don't want to see, this money that I put in go away. And that's what scares me about investing in the stock market. So this is a screenshot of the S&P 500 over a certain period of time. Anybody want to take a guess as to when this particular screenshot is? Okay, Daniel thinks 2020. And Julia, I see your question there. Let's see if we can get to that in a little bit. So we got one guess at 2020. We got these big couple big dips here. Any other guesses? Somebody says today, 2008, 2021. Okay, got some guesses there. All right. This is November 2014 to February 2016. You might say, well, what the heck happened there? Why would you pull that out, right? Nothing real remarkable happened here. This was this first big drop that you see in that August time frame there in 2015. Some big investors got nervous after a few days of losses in the U.S. market, and we went into the weekend. And then the Chinese stock market opened, and it went down with some big losses. And so people got nervous and they sold, right? The second big drop at the end there in February 2016, it was because things like oil prices were fluctuating, interest rates were fluctuating, and then Britain announced that it was going to have a vote on whether to leave the European Union, Brexit, right? So they announced they were going to vote on that, and that caused the markets to go down again. How would you feel if you are an investor and you're looking at this time, right? You look at your balances and you see one day you have this high amount, and then the next day everything's gone down, or a few days later it's gone down. How do you think you're going to feel about that particular situation in real time? Daniel would be sad, right? Sell. Yeah. You're like, oh my gosh, I don't want to lose more, right? Things are going down. So a lot of people get scared. This is a scary thing, right? Especially if you're constantly in there checking your balances, looking at where you're at. This can really freak people out, and it often does, and they'll often sell, right? Let's look at another one. Who wants to guess what time frame this is? And again, this is the S&P 500. All right, I'll show you. This is what Daniel had guessed earlier, right? This was COVID. So the end of that chart, or I'm sorry, the beginning of this chart is actually the end of the last one we looked at. Right after that Brexit announcement, this is what happened, right? So Jeff is saying, hey, I feel like I might be selling. This is what happened after that. Now, again, 2020, COVID, things go down. A lot of people get nervous. They want to sell, right? So a lot of people got scared and they pulled money out when that big dip happened. Let's look at it in context of up to just a couple of months ago. So if you look at the beginning of our first chart, 2014, you can see in red those are the two drops that we highlighted, that we zoomed in on. That first one, that looks like a blip, right? That is just a tiny little thing in the market. COVID, that was a huge drop. It didn't take long before it got back and recovered and kept going up, right? And so if you look at it in the context of what we know now, you probably want to put a lot of money in 2014, right? Because you can see where that's going. Yeah, it's time to buy, right? That's a big jump. And so if you would put $1,000 in the S&P 500 in January 2014, at the end of this chart, your $1,000 investment is worth $3,600. Your amount of money has more than tripled since 2014, right? Thanks to an average annual rate of return in the S&P in that time frame of 12.7%. So in that time frame, the S&P has actually outdone its long-term average. And so what we see in these drops here is a really important concept called loss aversion. If you've ever seen the movie Moneyball with Brad Pitt, there's a point where his character says, "I hate losing even more than I like winning." And there's a difference. And that is actually true psychologically. We are more unhappy when we lose what we already have than we are when we gain something that we don't. And so when you're looking at your investment balances and you see them go down, psychologically loss aversion kicks in, and that hurts you more than when you look at your balances and you see that they've gone up, right? You feel worse when they go down than you do feel good when they go up. And just knowing that can be a really powerful way to fight that natural tendency to want to freak out and sell when things go down a little bit, and help you to wait through some of these things, because on the other end of that is where a lot of the value is made, right? That's where a lot of what you're hoping is going to happen when you invest is going to happen. It's after those dips. It's after those losses. If you stay in for the long term, right? We're not gambling, we're investing, we're looking at long term. And so we want to make sure that we don't hurt ourselves in that. Now, on the flip side of that, if you just save the money, people say, well, that's safe, right? I'm just saving, I'm not putting it at risk, right? Here's what happens to the value of your money if you just save it for the long term versus invest it. If you had $100 in 2001 and you said, I'm just going to put this in my piggy bank, right? I don't want anything to happen to it. I'm just going to hold on to it. If you put it in that piggy bank in 2001, in 2023, your $100 has the same buying power as about 56 cents $56 in 2021 dollars, right? Or 2001 dollars. Because if you think about how many groceries could you have bought with $100 back in 2001, is a whole lot more than you can buy in 2023, right? And so the value of your money goes down over time due to inflation. If you had invested that same $100 in the S&P 500 in 2001, the value of the purchasing power today relative to 2001 is about $350. So there's risk in just leaving your money there, in just saving and not in trying to invest in the long term, right? So you have to make sure that you're not, again, assuming I'm not taking on risk by not participating in the volatility. So the important thing here is to understand that it's not about timing the market, it's about time in the market. So being a successful investor means that you're in the market for the long term, not trying to get in and out all the time and trying to make that quick trade and trying to, again, read the tea leaves. If you're in for the long time, you're going to do well. And you're especially going to do well if you do what's called dollar cost averaging. Dollar cost averaging is putting in the same amount of money on a regular schedule, regardless of whether the market is up or down, because it allows you to take advantage of when things are up, when things are down. You don't have to worry about it quite as much, right? And data has shown that dollar cost averaging for the average investor is going to be a much more powerful way to go than trying to hold on and figure out, when should I buy, when should I sell. If you're making regular contributions to a 401k or a workplace retirement plan through your employer every paycheck, you're already dollar cost averaging. You see these little increments throughout your paychecks, they're going to take advantage of buying sometimes in the dips, sometimes in the highs, but over time, you're going to have more value by doing it that way, right? So just by participating in a regular, paycheck or doing an investment at a regular time frame, if you want to invest outside of your workplace plan, you can do dollar cost averaging, and that will be better for you over time. Now, one common question that we get is, well, what should I do first? Should I save? Should I pay down debt? Should I invest? What makes sense? There's, again, not a one size fits all answer, but some things that you should consider when deciding for yourself is, first off, do you have an emergency fund, right? You should definitely have some cash on hand in case something happens, things go sideways, to be able to take care of those immediate needs. If you don't have that, that's probably your first goal, is to have some emergency savings. The next question you want to ask yourself is, do I have high interest consumer debt, like a credit card, something like that? If you've got high interest consumer debt, average credit card right now is, I believe, 23, 24%. You're not going to out invest a credit card interest rate of 23 or 24%, right? So work on paying that down, because you're likely to pay more in interest to the credit card than you are to gain in value from a reasonable investment. But that doesn't mean you need to pay down things like student loans or mortgages or things like that just because you have that debt, right? There are some debts that the interest rate is low enough, or it's not as big a deal, that it makes sense to invest first as part of your plan. So you can do both, right? You do all those things at the same time. So again, there's not a one size fits all answer, but kind of rule of thumb, you want to have some savings, you want to avoid high interest consumer debt, and then you want to start looking at, increasing your investments or making your investments. All right, we got just a few minutes here. I'm going to try to run through this real quick. Let's talk about the accounts that you can invest in, right? So why you should invest for the long term, what you can invest in, where do you do it, right? So a lot of employer sponsored accounts will be your 401ks, your 403bs, simple IRAs, things like that. You can invest outside of employers in an IRA, an individual retirement account, or you can open up a brokerage account, or there are some specialty accounts that cover specific types of savings, like a health savings account or that 529 educational account that we had talked about before. Now, each type of account will have its own set of rules, its own set of limits that you can put in, things like that. But just something to bear in mind, typically speaking, you can put any of these different types of investments in any of the other accounts, right? So your 401k will offer stocks and bonds and funds. An IRA, you can buy stocks and bonds and funds. A brokerage, you can buy stocks and bonds and funds. The accounts themselves are like containers, and the investments are like drinks, right? You can pour your investments into different types of containers, and that's okay. So you don't have to worry about investing in very specific things in just one type of account or another. Another question that people often will ask is, what's the difference between traditional and Roth? I hear that all the time, and I'm scared. I don't want to make the wrong decision, right? If you're investing, whether it's Roth or traditional, you're making a good choice, right? It's about taxes and timing. Traditional accounts, you get a tax break today. You're going to pay taxes when you take the money out in the future. Roth accounts, you're paying taxes today. You're going to get a tax break when you take the money out in the future. The question you're asking really is, when do I think I will be at a better tax advantage? And that question you can answer, with some degree of certainty, but you don't know what taxes are going to look like in the future. But don't worry about making the wrong choice, right? If you just pick one and go with it for now, you can adjust later. You can invest in both over the same year. Don't let that be the thing that stops you from investing. As I mentioned, every account will have kind of its own restrictions on things, right? So rather than me explain that to you, it changes all the time. It's going to change here in a few weeks as we, tick over the calendar to the next year. You can just do a quick Google search. What are the rules around 529s, 401ks, simple IRAs? How much can I put in? When can I take it out? That sort of thing. You'll be able to find that very easily with a Google search. One question that came up earlier was about large cap funds or large cap investments. So here's a quick kind of primer on reading an investment menu. You'll probably see this in some capacity, maybe in a 401k plan or other stuff, right? They're going to show you the name of the fund. They're going to show you the type of asset class that it's in. So is it stocks? Is it bonds? They're going to talk about the category, right? Large cap, which means big companies, mid cap and small cap, which are not small companies, but are smaller, right? Comparatively. They're going to show you how much those funds have earned over different time periods, right? So you can see sometimes some funds perform really well in 1 year or 3 year time frame, maybe not so much over 10 years, but you can see different things there. I'm going to run through this real quick because I know we're right on time. The other thing to watch out for are expenses, right? So look for the expense ratios. You want to see are the investment returns including those fees and those expenses. If they're not, you really want to pay more attention to those. And then just some quick tips to increase your retirement savings, your investment savings. If there's an employer match, get that all the time, right? That's free money. You can automate an annual contribution rate increase usually, right? So you can bump up your contribution rate a little bit every month. Increase your contributions when you get a raise, especially if you don't feel like you need that money. That's a quick way to find some cash to add to your retirement savings. Just say, hey, I got a raise. I'm just going to move all that into more investments. And then as you pay off debt, reallocate those debt payments to increase your wealth building fund by increasing your investments. And let me stop there, Sadie, because I know we're right at time and I don't want to keep you guys any longer.
Excellent. Thank you so very much for all of the information. Is there any last minute questions for Scott?
And you guys can always feel free to reach out to us over email or set up a free coaching call, and we can kind of dive into specific questions you might have, or if you want, you want to learn a little bit more about this stuff. We are not financial advisors, so I can't tell you, here's what you should invest in or kind of run through